Hi, everyone. Welcome to the Yes Investment Club. This is the fourth chapter of the basic investing course. And this chapter focuses on the stock research and selection. So every investor asks a speculative question, which is, should I buy this stock? But this is a wrong question to ask. So this chapter will tell you how to answer the why in why should I buy this stock by informing you about different research and selection methods to select a revenue generating stock. So in this chapter, we'll cover how to do stock research. Then we'll talk about ratios. Then we'll go to stock indicators. And the last part we'll cover is risks.
First, let's talk about stock research. So this is probably one of the most important aspects of investing because investors have to choose very carefully when it comes to their stocks. It can essentially determine whether they go to a profit or a loss in the short term and long term. So you have to consider a variety of things when it comes to this. But for now, we'll focus on some of the things that investors consider in a company before they start investing in its stocks. All right. So the first is the income statement. So what the income statement shows is a company's income and expenditures over a period of time. It can also be used to indicate whether the company is making a profit, loss, or breaking even. Every statement, it focuses on four main components: the revenue, the expenses, the gains, and the losses of the company. And so it's a full-on breakdown of everything that the company earns from the selling of its good, all the costs that it has, whether it be production costs or taxes, as well as any other expenditure or gain that it has from, let's say, operating over a financial year. The next is the balance sheet. And what the balance sheet essentially allows you to do is look at the company's current assets, liabilities, and stakeholders' equity within the company. So assets are basically whatever the company owns and whatever it's using right now, whereas the liability is something that it might be responsible for. So let's say advertising, if it advertises improperly, that would become a liability for the company. And then finally, the stakeholders' equity within the company. What this basically means is that it's the amount of the company's stocks that investors hold. And so balance sheet focuses on financial side of the business primarily, looking at what the company owns and to who the company owes. So whether it has some debt to pay or has no debt to pay.
And one more thing to add is, so the balance sheet is actually a holistic overview of how the company is performing. So with assets, the company is showing that what it owns, wherein like it is showing that these many assets are owned and this is the value of assets. The liabilities are actually what it needs to pay, right? So it's showing a difference between what it owns and what it needs to pay. And that's how you get to know whether it has a good approach and it is maintaining its finances really well or not.
The final thing most investors look at in a company is its cash flow statement. So, as its name suggests, the cash flow statement is a document that shows how much cash is entering the company and exiting the company. So, the income statement here only shows how much revenue or expenditure the company makes. But what the cash flow statement shows is where the company is gaining revenue or expanding its capital. So, it may compare gains from last year compared to the current financial year and show the difference between the company's performance. This is usually a make or break for most investors because it shows how much the company has improved or has receded in its performance over the past year or so. And so what this essentially shows is that when all of these three documents are put together, it gives the investor a thorough understanding of the company's current position. And so you can use this in information to decide whether the stock is actually a worthwhile investment for their portfolio, because profitable companies will likely have less very few losses and will be much more efficient with their finances. So this will lead them to have more valuable stocks, but companies that earn lesser profit and have more inefficient prices may have a less valuable stock price because it's likely that they have more costs that they have to consider when carrying out their activities. So what these documents just go to show is it just reflects a company's stock and why it is performing the way that it currently is in the markets. So what these questions essentially do is, if you've taken into consideration all of these documents, it's likely that you'll be able to answer all of these questions because you will probably have a thorough understanding of how the company is. And so that's why you'll be able to answer what these questions entail.
Okay, so now we are going to talk about stock ratios, and we're going to understand what are stock ratios and how to use them. So, first of all, we need to understand the importance of the stock ratios. So, firstly, the ratios help analyze certain parts of a company and quickly inform investors about the company's performance. So, for example, a company is making large amounts of revenue or may not be making too much of profit, right? So, to understand the profitability or the revenue of the company, an investor has to employ a ratio to truly understand or dive deep. Deep dive into the extent of the company's profitability. So the ratio has to be used accordingly, right? Um, all these ratios should be only compared to the sector or industry-wise performance, so that you get to know where the company stands in an industry. If you're comparing two different industries, you're not actually comparing two companies, right? Because each company varies in their variable fixed cost or their performance, their target audience, etc. Right? So it's important to note that these ratios are restricted to industry comparisons only. Okay, so there are several types of ratios, and we'll try to cover all of them in this one. So the first ratio is earning per share. So the earning per share is actually how much money a company makes for each share, which can also be termed as revenue per share, right? And the formula that's used to calculate is net profit upon number of shares. So the earning per share is used to tell an investor the corporate value or the market value or the profitability of a company, right? So moving on to the benchmarks, understanding the uses is one thing, but understanding the benchmark is also another thing wherein you get to know that what do you compare it against, right? So for earning per share, you don't need a specific benchmark. The number itself tells what the company looks like, right? So if there's no benchmark, so you need to interpret the EPS values. So the if it is a high EPS, it shows that there is a high profitability for an investor. And if it is low EPS, there is a low profitability for an investor. So we'll take an example and understand how this looks like. So in this example, you can see that the net income of a company, like the money it earns, is rupees 100 for simplistic terms. And the number of shares that are being traded in the market, like the outstanding share that can be traded or bought by us, is 50. And therefore, the EPS will be 2. Why? Because we'll divide the net income upon the number of shares, which is 100 divided by 50, which is 2. So what the EPS value says is like
it's 3 o'clock.
Cut this part, okay. So let's understand this with an example. So the net income of the company is rupees 100 for simplistic terms. The net income is actually how much a company earns after selling its goods or offering its services, right? So, and the number of shares being traded in the market is 50, which means that you and me can buy 50 shares. That is the total number of shares that we can trade. And the EPS, which is the earning per share, will be rupees 2. Why? Because we'll divide the net income with the number of shares, which is 100 divided by 50, which is 2. So this means that per share, the company is able to earn rupees 2. In layman's term, if you're investing in one stock of a company, you are giving a company or the company is earning rather rupees 2 because of your investment, right? This is earning per share. So what it's trying to show is if the earning per share, like if it was not rupees 2, it was rupees 5 or rupees 10, and it has a high EPS value, that means it has high profitability, right? You don't want to invest in a low EPS value, because even if you're investing or contributing one stock or buying one stock, you're just making their profitability only increase by a low margin, right? So just consider that the stock should be of high EPS value. Second is the PE ratio. So the PE ratio is simple terms is the price to earning ratio that tells what the market is willing to pay for a share of the company for each rupee of each rupee of earning. So the formula is current market price, which is P, divided by earning per share, which is E. And the earning per share is actually the previous ratio that we used. So the usage of this PE ratio thing is it tells the investor whether the company is undervalued or overvalued. And as for the benchmark, there are no specific benchmarks as every industry has a different PE ratio. So the interpretation for this is if there is a high PE ratio, the company is overvalued and you should not invest. And if there is a low PE ratio, the company is undervalued and you should potentially invest in the company because you will get the normal value of the company after a certain duration when the company's sales grow over time, right? So to take an example of this, we'll see that the considering if there is a company X, right, and the overall earning of company X is rupees 1,000, and the number of shares being traded is 100, right? So first we need to calculate the E in the PE ratio, which is the denominator, and E is nothing but the earning per share. So the earning per share here will be 1,000 divided by 100, that is equal to 10, because we'll just do the net income divided by number of shares, right? So now considering the EPS is rupees 10, we'll move on to the next part, which is the market price. Now, it's important to know the market price for the PE because what we'll do is right now, we'll understand the market price is actually rupees 50 and the earning per share is rupees 10. So we'll just divide 50 divided by 10, which is 5, right? So market price divided by EPS gives you rupees 5, and that's actually the PE ratio. The rupees 5 is actually the PE ratio. What it's trying to say is this means that you are paying rupees 5 for getting rupees 1 of the company's earnings, right? So I hope that makes sense. Now we'll move on to the return of equity, which is the ROE ratio. So this, what this tells us is that the rate of return for a stock when you invest in a company. So considering the formula, the formula is net income divided by total equity into 100, which gives you a percentage answer. And always return on equity is measured in percentage. So that's why it's into 100. And the usage of this a PE ratio, the return on equity ratio is to tell that how good a company is in generating returns on a stock investment, right? So you want to understand return of equity because you need to gauge an understanding of how well it will give you returns, right? As far as the benchmark concerned, the ratio varies according to the sectors and industries. So investors have to compare from company to company. And interpretation of the ratio is that if there is a high return on return on equity, there is a high profitability for an investor, and if there is a low return on equity, there is low profitability. So the example here is quite simple. So if a company's net income, what it generates is rupees 1,000, and the total equity, which means the total outstanding number of shares that can be traded, is 8,000. What we'll do is we'll divide the net income with the total equity and multiply it to 100 to get the percentage. So here in this case, it will be 1,000 divided by 8,000 into 100, which will give you a 12.5% return. Now, the important part is here the 12.5% return is not on the net income, it's actually on the total equity, right? So 8,000, the total equity, it is giving a return of 12.5%, which is actually a good number, right? Because there's a good profitability of 12.5%, it's better for the investor to invest. If the number was ranging around 1 to 5, or it depends on per stock, then it's questionable to invest because it hinders the profitability of the company. Moving on to the price to book ratio, or the PB ratio. So the price to book is actually a comparison of the company's value in the market to the book value. So book value is actually the actual value of the company on paper. So the book value can be thought of as if a company, if it stopped doing all business, paid off its loans, sold its interests, sold its assets, and got through all the liabilities. So then what will the value of the stock of the company be, right? The book value is actually the actual value if it if it stopped doing business, right? So the formula for this is market price of a share divided by book value per share. And this tells the investor that whether the company is undervalued or overvalued. And as far as the benchmarks concerned, um, there is no specific benchmark for this industry because every country also has a different PB ratio. So for interpretation, there should, if there is a high PB ratio, the company is overvalued, so you should not invest. If there is a low PB ratio, this undervalued, you should invest. Why we are suggesting undervalued companies is because over the duration of the time, the market will correct itself, and the undervalued company will become the normal. It'll receive its actual value, right? So you are actually receiving a growth from undervalued to the normal value, and that's why you want to invest in this. Overvalued companies can take a shock anytime soon, right? Overvalued, even though they have a good value in the market, but it's actually not the true value, so there is a high potential to risk. So coming on to the example, and this example is particularly important to understand. So if a company X has an income of rupees 1,000, and out of this it has to pay the loan of rupees 100 or rupees 400, but it also has valuable assets that is priced at rupees 200, which the company decides to sell. So the total book value will be rupees 800. Why? Because from the net income, whatever it has earned, it'll pay off the debt of rupees 400. So it'll subtract 1,000 minus 400. And then the valuable assets that it owns, it has sold, either to pay the loan of or to increase profit. So this will be 1,000 minus 400 plus 200, which will give you the total book value of 800. Now, if the total book value is of 800, sorry for the typo over here, then and the number of outstanding shares that are traded is is 100. The total um, book value per share will be rupees 8 because it will be 800 divided by. So now let's understand the price to book ratio with an example. Here we are considering company X, and the company has an income of rupees 1,000. So and now this company actually has a loan repayment to do, which is costing around rupees 400, but it has actually valuable assets that are priced at rupees 200, which the company decides to sell. So the total book value will be rupees 800. Why? Because out of the total income, what it has earned, it'll pay the loan by paying rupees 400, which will be 1,000 minus 400. And because it wants to maintain profitability, or it has extra assets that it can sell, it'll sell the extra asset with a value of 200, which is an additional income to them. So it'll be 1,000 minus 400 plus 200, which will give you rupees 800. And that's the total book value that the company has. So now we have to consider the market price of this company. So let's consider the market, the outstanding shares that is being traded as rupees is 100, and the total book value that we have calculated is 800, right? So the book value per share will be 800 divided by 100, which will give you 8, because we're just doing total book value upon number of shares, right? So now we'll use this book value to calculate the actually PB ratio. So if we now know the book value, we'll move on to the market price, wherein the market price is rupees 80. Then the PB ratio will be 80 divided by 8, which will give you 10, right? So because we're just doing market price divided by book value per share. So what this says is that the company that is being traded 10 times the book value, right? So just for an real life example, you don't want to buy a share that is 10 times its actual value, right? It's actually just being overvalued, or the investors are just putting sentiments into the market that it's a good company and you should invest, right? So lower the PB ratio, it'll be better for the investors to invest, because they'll understand that it is ranging around the normal value, and that's why you should invest. So moving on to the last ratio that we have, which is the dividend yield ratio. And this is a little complex ratio to understand, but it is quite helpful to understand the returns. So the dividend rate, first of all, for the dividend yield ratio, we have to understand the definition of dividend. So dividend is the amount of the amount the company pays to its existing shareholders out of its profit as a reward to its investors. And this is usually done on the per share basis, right? So it's from the profit and it is given to the investors, right? And dividend is not actually compulsory for a company, because the company can use the profit for research and development or expansion of their factories or something, right? So dividend is optional, and the companies who give dividends is actually preferred by the investors, because you are not only getting the increased value of the stock prices, hopefully, but also the dividend, because the company is taking care of the investor and telling them that, okay, we have extra profits and we are willing to share them with our investors because they have showed trust in us, right? Now, moving on to a dividend yield ratio. So the dividend yield is actually the amount of money that a company pays to its shareholders over the course of the year with respect to the stock price, right? So the formula for this is that annual dividend received per share divided by the total value of the investment. So this might sound daunting at first, but we'll look at an example in the next two slides and we'll understand. So the usage of this dividend yield ratio is to show the return of investment that an investor might expect while he invests in the stock. And the benchmark is to compare other similar companies in their industry, right? So if you want to compare Infosys with what do you call Wipro, right? They're both are IT companies. That's why you'll compare them both, right? So in terms of interpretation, dividend yield ratio is only applicable to companies that give dividend, right? So if a company is not giving dividend, you possibly can look at it, but it's missing one key component of the return. So moving on to the example. So consider if a company is making a profit of rupees 1,000 shown in the middle of the diagram. Um, so now out of this, it decides to keep rupees 100 for business expansion shown by the right side of the diagram. And it decides to distribute the remaining profit of rupees 400 amongst its shareholders, right? Here, we have to consider that the company has 100 shares outstanding in the market, which means we can trade 100 shares. So each shareholder will actually receive a rupees 4 dividend, right, per share, which is because we'll just do 400 divided by 100, which is the amount of profit divided by the number of outstanding shares, which is 4, right? So per share, actually, you will get rupees 4 into your bank account. So for example, if you have 20 shares, you will earn a dividend of 20 into 4, which is 80, right? 80 rupees. So now after understanding the dividend, we have to move on to how many number of shares the investor holds. So if the investor holds 20 shares and the value of each share in the current market price is rupees 15, so the total value will be rupees 300. Why? Because 20 into 15. Now to calculate the dividend yield, like how much yield are we receiving or how much return are we receiving, what we do is 20 into 4, which is the number of shares into the total dividend value, which is 4, 20 into 4, which gives you 80, divided by 300, which is the total value, into 100. So that will give you 26%, right? So to just revise the formula, it is actually the annual dividend yield upon the total value of investment. Hope that's clear. So this shows that the investment of rupees 300 has made a return of 26%, which is actually good return because you're earning 1/4 of the money back only through dividends. This is not accountable for the stock prices rising or the economic prosperity or any good news or anything else, right? So only through dividend yields, you're earning a 26% of return. Now there are other methods too. These are not in the form of ratios, but and general understanding of the market and the stock performance of the company. So you can just consider the 52-week high and 52-week low. What this means is 52-week accounts for 1 year, right? So 1 year high, which means what is the stock price, the highest stock price gone by the company over the past 1 year, and for the low it is the lowest price over the past 1 year, right? This shows that where you are averaging out, right? So if a company has 52-week high at rupees 100 and a low at rupees 70, and it's ranging around right now at 92 rupees, right? So the call you will take is it'll be buying the share because it is close to the 52-week high, and possibly because of economic prosperity or the growth in the market, or the performance of the stock, it can grow above the 52-week high. So these are just the other methods.
Okay, so now we'll go into a few more tools that can help with stock research that are known as stock indicators. So we'll be learning about what stock indicators are and how we can use them to better trade stocks. So stock indicators are a type of mathematical calculation that creates patterns and displays trends, and you can use them to make better investment choices. A lot of you will probably recognize the graph that you see on the right, where as people who go into stock research often see this display of like profit and loss. And it's something you'll find very common if you're doing stock research into and using stock indicators to help make decisions.
And this is an example of like fundamental analysis that traders do. So fundamental and technical analysis are based on quantitative modeling of the stock. And instead of speculating the prices, they actually analyze the future behaviors of stock.
So there are a few different types of stock indicators. The first being the PL, which stands for the profit loss indicator. So the profit loss indicator is used to show an investor how much profit or loss has been made on the original value of investment in a stock. So profits are typically shown in a green color while losses are shown in red.
And just to add on, the profit or loss can also be seen on like when you trade a stock. We'll go through the example in one of the chapters. So in there, the profit and loss is shown through the last traded price, right? So if it is rupees 2,300 being the last traded price, and the market closed, or then the market reopened at rupees 2,400, there's a 100 rupees jump, right? But from the market closing of the previous day to the market opening the next day, right? And that will be represented by a green arrow. And similarly for the loss, right? So profit and loss can be through the last traded price or the original opening price.
Yeah, absolutely. So the next is known as the want indicator. So the want indicator shows the volume of a stock traded in a given day, similar to how it shows how much demand there is for that stock in the market. And the higher the volume of the stock trading, the more they want of this stock and vice versa. So you can see that the higher volume means there is more want, and a lower the volume means there is less want. And that you can use that to then see where the market is inclining towards, how many investors are purchasing this singular stock, and if people are shying away from a certain stock, it might be unwise to invest in it. So volatility is one of the more complex indicators that stockbrokers use. So a volatility indicator is a technical tool used by investors to determine how far a traded stock or security derivatives deviates from its original listing price. This indicator is used to understand the market forces and their effect on the stock. So if prices tend to fluctuate lowly, that means that demand is very stable. Whereas if there are huge price fluctuations, it means that demand is very unstable. Investors use this indicator to understand which stock they should buy, because a consistently stable stock will also showcase more stable growth over time. Whereas stocks that show really, really high profit or really fast losses will be much more unstable and incur a much higher risk to invest in. So borrow indicators are used by brokerages and investors to understand how easy it is to sell the stock of a company. So this is almost used in cases of damage mitigation. For example, if a stock does not seem to be trending upwards, and borrow indicators can indicate to investors how easy it will be to sell those stocks, and it is often used in short positions for this very purpose. Noise can basically be defined as any market activity, usually within a much more shorter time frame, that hides from or confuses investors about the actual market trends. These include factors like news and events and action of the company that will try and sway the investor into investing in a certain stock by actually distracting them to the actual data that is being shown. And other methods and indicators that stock investors use are things like average indicators and trend indicators, which show the average growth or average decay of a stock, and whether it's trending upwards or trending downwards, and that can influence the decision you make about whether or not to buy something. Momentum indicators are also really very important, because they indicate how a stock is moving. Where if it has positive momentum, that means it is likely to grow in the future, whereas things with negative or sideways momentum are much more likely to decline or remain stable.
Right, and now we'll be talking about risk. So we'll be talking about what exactly is risk and how to manage it properly. So firstly, what is risk? So when it comes to the financial world, risk is defined as the chance that an investment's gain will differ from its expected outcomes. And so it usually refers to the fact that while investing, there's always a risk to lose a part or a whole value of this investment. So it's very commonly agreed that investment should typically be made in low risk stocks because you just don't want to lose like all of your money immediately. So as Benjamin Graham said, successful investing is about managing the risk, not avoiding it. So we'll be talking about the different types of risks now. And so there are three kind of broadly categorized types of risks. So firstly, there is the low risk. And the low risk suggests that there is a very small chance that there will be a loss incurred from this investment. And so a low risk investment is also usually considered a safe investment because most of the time it results in the benefit of the investment. And yeah, so basically there's a small chance of loss. So in return, there's obviously a small change of reward, but this is apparently more safe. And it's taken in the day-to-day trading. And for medium risk, a medium risk is where there is a both high factor of risk and a high factor of reward involved in the investment. And so usually medium risks are taken when companies are frequently being traded. And so the stock of these companies are usually more volatile, so it can be a good option to get a really good reward. And moving on to the high risk. So a high risk is an investment that has a very high chance of creating not only losses, but also more adverse negative effects for the consequences. And so the risk of losing the investment, not all of its value, is very, very high. But if the investment is successful, then there can be just as a great, or if not greater benefits for the investment as well. And so this is usually taken when the market is going to be drastically affected by a particular news or event that's happening in the current world. And so these are three companies that we have labeled as whether their stock is of low, medium, or high risks. Originally, we were going to ask you to guess the level of risk, but we've absolutely portrayed it here. So this is actually from the perspective of the market itself. So technically, for each investor, they will have a different perspective on whether the stock is of low or high risk. But for example, it's very commonly understood that Reliance is of a medium risk, ITC Limited of a low risk, and this IIFL Securities of high risks. So those are kind of like the most common examples.
And just to add on, because these risks are labeled like low, medium, high, the investors typically look for companies that are of low. Now, Reliance medium because it has a stable company growth and Reliance Industries is continually growing, right? So it has a low potential of failure or loss making because companies or foreign investors are continuously investing in the company. So this news makes it a medium risk stock. ITC Limited is actually a monopoly in the tobacco industry, right? So being a monopoly, nobody can easily enter or baffle this company because it has the highest amount of market power. And because of this, there's a low risk because it will maintain its stability and no such other competitor can actually determine its value, right? So being a monopoly is actually an advantage to a company. And high risk IIFL securities means it actually is investing money for for funds for investors and etc. Right? And considering IIFL securities is like making risky investments or not getting returns or giving returns that are not optimal or optimal, it can matter, right? So it depends totally on how the market performs, and that's why the stock itself is considered as a high risk stock.
Okay, so now we'll be moving on to comparing risk with return. And so most investors take into considering the risk versus reward factor of their investment. And this means that they consider whether the risk of investing their money is worth the reward that they're getting. And so If the reward is larger than the risk, then it's a good investment. If it's the opposite, then obviously it's a bad investment. And during the time of, if it's a bear market, and usually people won't invest because that means the market is declining, and that's not very good. And if it's a bull market, then people will be investing and or holding their shares. So, for example, most investors may not choose to invest during the time of the bear market because it is not known when the market will recover from the downturn. While on the other hand, investors will likely choose to invest and hold on to securities during a bull market because of increased growth and overall economic prosperity. And so the benefits of investing during a bull market run outweigh that of the bear market. And so the risks associated with investing are the same. And so investors will tend to invest in the bull market. Moving on, so risk management. And so risk management is basically the process that investors undertake to identify, assess, and control risks that occur. And this may be done through certain techniques such as liquidating certain assets to make the stock portfolio better, relocating money to different funds, or selling many securities to avert the effects of the risks.
Great. This brings an end to chapter number 4. Thank you so much.